If you buy a cash flowing asset in the next year and a half, I'm pretty confident you're protected from a lot of the downside risk, a lot of the potentially losing money, and more than likely you'll make a lot of money. I cannot say the same for the stock market at this time. There is a potential to lose a significant portion of money in the stock market. It may not happen. I hope it doesn't. But I'm personally much more comfortable protected from that volatility and losing 20, 30% on, horrible stock market crash. I'm protected from that by investing in hard assets that'll hold their value in cash flow and pay for themselves.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
What's up, guys? Welcome into another edition of the Get Invested podcast with your hosts, Jordan and Matthias. We're excited to be here. Talk to you about all things investment, finance, real estate investment, real estate, and all kinds of things in between. Speaking of things in between, I've realized in editing the last few of these podcasts that it's really hard to say the word hosts and the AI transcribe it correctly. Like it always sounds and reads as I say with your host, Jordan and Matthias. And so that, I put a little extra on that one. I was make sure everybody knows that I do know that there are two people here, but we are both here. Yeah, we're both here. As you can see, if you're watching and also listening, I suppose you've heard two voices. I'm not a ventriloquist, but we're going to switch it up a little bit today. And we're not exactly revolutionizing the podcast here, but rather than talk about one topic at length, we're going to hit a few topics that we feel like are interconnected. At least we hope to prove that they are. Hopefully our thesis has a through line. We write cohesively in this podcast, breaking out the
I think our transitions are going to be on point today. I think.
Yes. Yeah. We are going to signpost and make sure we have topic sentences that connect the ongoing paragraph to the previous and do all those
and
great things. Believe me, I edit your writing. I know. So we're going to talk about a few things, a little general, a little specific, but for now, just to get us started off here, Matthias, what's been up, man? What's been going on since we last talked?
Well, been pretty crazy week, pretty busy, a lot going on in the real estate investing game. Yeah, basically just super stressful, a lot of movements and not a lot of sleep, some stress on my end. So I got up at like 4 this morning. I was wide awake, couldn't get back to sleep. So woke up, did some quiet time reading, which was nice. I don't get a lot of time to do that. So then until it was like the sun was starting to come up, and then went for a nice long run, which also I don't get a lot of time to do, but it was nice because it was beautiful sunrise. It was a long run. I told you.
There it is.
No, it was a beautiful sunrise. Yeah, just Forrest Gumped it, dude. Just kept going. Which was nice, taking that time. It was good for like my stress levels. So, just kind of get a good sweat in. It's very warm. It's like 75 and very humid here. It's summer. It's officially summer. We were in the pool last weekend, so well, I say we, my sons were. I was busy. But yeah, so just taking advantage of this morning anyway, taking advantage of a little extra time I don't normally get before the kids woke up and bus time and all that. So, surviving, but very stressful times. What about you?
Yeah,
I see your jersey.
Well, yeah, well, we'll get to this. We'll get to Wrexham in a second. And I have a number of thoughts. Yeah, I mean, it was an amazing weekend. But I was going to say, that can be, and a lot of people talk about it, but it is so true that it's such a truism to say it's so hard to force yourself to take that time when you're feeling pressure or when, in any sort of way, stress, anxiety, got a lot going on, whatever. But like, it's so true that it's so hard to make yourself take that time. But if you do take the time, inevitably everything is better. Right, like you're probably better. More productive. Yeah, you're better. Yeah, everything. But it's really hard. The same thing happens to me when I'm like, oh no, I don't have time to go get in a workout, and then I do, or Rachel and I go or whatever, and then everything is better. It's doing those kind of things over and over again, though, man. That's where it's tough. I actually pretty standardly have that kind of quiet time reading. Well, I'm not trying to read before kids wake up. So I guess it's not quiet time in that sense, but Rachel gets up early to go to work. I mean, the school starts at 7:15. So she's up before 5. And I used to get up that early too. So I often am awake, whether because of biorhythms or because she's awake. And a lot of times I can't go back to sleep either. So I tend to read until 6:37 and then either get up and work out, or actually sometimes weirdly, I'll go back to sleep for like an hour, but like, I don't know why. But
unheard of in the Wilson house. Sleep after getting up? Not a thing.
Yeah, usually by that time the cats are eating and they're like, okay, snuggle time. And then I'm like, maybe it's snuggle time. I don't know. But I was going to say, before I get into the triumph, I do have to admit that this week you would have been laughing because I was finishing up painting and, doing the regular painting is fine, but like the touch up is where you really need that skill and practice. And I was just looking around. I did a pretty good job, but you would not have believed it was like an Abbott and Costello routine there for a little bit where like I was trying to touch up the ceiling and I'd get ceiling paint on the walls. And then I had to go back and hit the walls a little bit and maybe hit the ceiling. And then back and forth. Yeah. Nice. It was like I was like breaking out different pails back and forth. Man, it's tough. And then also just this ceiling is, it's been, the paint is soaked in so much that you get new paint on it. It takes so much to cover it up. And so I was having to go back. It was a learning experience. It took me just as long to paint like, I don't know, 25 square feet of wall as it did to paint like 2 rooms because of how much I was trying to. And I'm doing it like over stuff. Like I'm like above my bed. It's not like I can like lay plastic over everything. So I'm like,
sure.
Just really closely doing it. Yeah. So going back and forth on that. Happy to be done with that though. Happy to be done with that.
Oh, that's nice.
We did this super jock thing this weekend where we went on a bookstore crawl. Yeah, that's right. That's where you go to different bookstores and look at books. It was a promotion for like local bookstores in the city. So cool. It was cool. And, a lot of them we haven't, we wouldn't go out that way if there wasn't a specific reason why. So kind of discovered some cool spots. But yeah, the weekend was really dominated by Wrexham earning their 3rd promotion in as many seasons, back to back to back. Never been done in the English Football League ever. So we're going to be in the championship next year, which is
one step
very
below
exciting.
The Premier, man.
I know it's very exciting, but it's also like a bit trepidatious. Like I will be, I mean, we're like almost nervous in the top 10 of leagues in the world, right? Like, so they are, I mean, I will be ecstatic if Wrexham finishes like upper middle table next year with like an outside chance at the playoffs, right? Yeah. I mean, I think any Wrexham fan would be over the moon if they even like slid into the playoffs, but I doubt that. Just solidly competing.
Yeah, just so it was. Don't be in the basement to where you could kind of fall right back. That's
definitely don't be sweating. Yeah, flirting with relegation, because I mean it's a different. It's going to be another step up in a way that the rest of them really haven't been. So that Ryan and Rob got their work cut out for them, and Phil and all the front office. But if I may, the only thing, and now I'm going to actually bring this back to investing, believe it or not. But I'm
excited.
The only thing it's been all joy that Wrexham achieved this. And obviously I'm wearing the jersey, the kit. No, I guess technically I'm just wearing just the jersey because I don't have the shorts on for the promotion, though this is 2 years ago. But if I could just speak to the haters out there, and of course, no one that listens to this podcast would ever be this type of person, but maybe if you know this type of person, pass it on. There's been so much blowback about just like, oh, the Hollywood Wrexham. Oh yeah, they just buy the best players. Of course they're going to get promoted. First of all, listen to what you're saying. Whoever has the best players usually wins. Now, we all know those scenarios where people paid a lot of money for a bunch of players that didn't work together, right? I mean, pretty much every other year this happens for the Yankees or the Mets or someone.
Lakers.
Right. Lakers, definitely it has happened as well. And I get it. I get the idea. I have been known to complain about the Yankees for so many reasons. And one of them is, and the Dodgers now too, that there's no salary cap. And that's kind of crazy. But these people out here hating on Wrexham for finally having like invested ownership that it's brought jealousy. About. Exactly. It's like, are you just mad that like this team that's not supposed to win wins, or you're mad that it wasn't your team? It really blows my mind. Like, have you looked at the wage bills of Man U and Man City and Tottenham Hotspur and Dortmund and Bayern Munich and Real Madrid? Are you on their stories being like, yeah, you just bought all the best players? because that's what they do every single year. Now, in the matter of like Tottenham this year, like it didn't do anything for them, nor Man U. So that's the other point though that I wanted to bring up, and this is where it comes to investment. I promise you, this is actually tangentially connected. Which is, and we talked about this. We wrote a newsletter about this very thing, a couple of them. What I think they are mad about is it's jealousy, but it's also because Wrexham, Ryan and Rob made Wrexham cool, and not in some fake flashy way like I would argue the Lakers are or the Yankees, but in a way that like people see the meaning of it and they got excited about what they were doing and how they were investing not only in the team, but the community, the region, the whole idea of this phenomenon. And you know why they were able to get a lot of the best players and then get them to play together is because, or best players for their league, of course, right? Get people come down from upper levels is because they could sell them on the product of Wrexham. Yeah. They're not going to take a pay cut or drop a league just cause. I mean, even just for the money. These are competitors and they could probably get that amount of money somewhere else. So the idea that just, they just threw around a bunch of money. I'm like, the entire EPL is owned by billionaires pretty much, except for like, well, Luton Town dropped out, but almost all of them, right? The Charlotte Hornets are owned by billionaires. Now, NBA has a salary cap, but it also has its luxury tax. So, was I annoyed that KD and Steph Curry were on the same team during the Warriors dynasty? Yes, because that seemed fake, not organic. Is it cool that OKC with draft picks has like become the best team in the NBA and it's all like development? Yes, but that's not how it works overseas. You have a percentage you can spend based on what you make, and they made it cool so they could spend more and they could convince players to come. And somehow this is buying a trophy when billionaires own all these teams that finish 16th in the EPL like every single year. I know it's a little bit of a rant, but the point is that if you invest correctly, it's not about necessarily just the money. It's about what you do with the money and how it affects humans. And I know that's something that, and that's what we focus on as well in a very different way. But it drives me crazy. And I mean, I get it. Ryan is very handsome, so everyone's going to be, a little upset about that. We have the most handsome owner. That's, get over it. But
yeah, I would say also, I'm done. I saw an article after they won. I saw an article that apparently what they bought it for was $2.5 million was what they bought from $2.5 million, and now I saw valuations just under $1 billion in a amount was like 5 years total, 4.5, 5 years, something like that.
I think they bought it in
like 4 seasons ago,
beginning of 2021.
Yeah. So
this is their fifth season. Well, hold on, they had a half of a season, and then they didn't get promoted, and then 3 seasons of promotion. Basically. Yeah, 5. Yeah, so in 5 years, $1 billion seems high, but I've definitely seen like in the hundreds million. Of millions.
I saw, maybe it was 100 million. Maybe it was 100 million.
Yeah. I think I have seen like 100 to 200 million.
There was some digits being added, and it was pretty impressive. I'd like to buy.
It's like 100%. It's like 100 times. It's worth like 100 times more, essentially, 50 to 100 times more. Go. And they didn't do that by just like coming in and just outlaying cash. That's not the only thing, Just throwing it. It's a brand. Also, let's in the ranks of sports ownership in the EFL, they are not
anywhere close,
even close to the wealthiest. Now they did get some help from the Allens, who are billionaires, but they're a minority stakeholder. I mean, remember the whole story is Rob could not afford to buy them by himself, so he had to get someone else to help him.
Some what do you call it? He called it
it was cell phone magnet money and
cell phone magnet, and then the movie, the Deadpool money. He needed some of that Deadpool.
Oh yeah,
money.
franchise money. Yeah, Marvel franchise money. Yeah. Anywho, I know that these are just haters out there who are not thinking through all this, but it just highlights that they invested in human capital in the right way. They don't even have their own training ground, and they convince people to come down from good championship level teams. So they're working on that, but it's just proof of they were smart about it. And, guys, I know America and Canada are having some troubles right now, but we can just look to Rob and Ryan and see how America and Canada work together.
Nice.
Yeah. So I say that to segue.
Sure.
Because tensions with Canada and America are part and parcel of this whole situation we're in right now with the tariffs and the uncertainty in the market. And I got to say, to me, not only do we have, the stresses of the pipeline being affected by supply chain, the most favorite phrase of the COVID era.
Oh, yeah.
Yep. Being affected by possible tariffs and the uncertainty there. And then, not getting along with China. But also with the tech industry, that's a big thing. But also just Apple, Google, and Meta are all currently under significant scrutiny, if not lawsuits.
Yeah, I think all of them are
To
under
they're all in lawsuits.
or another.
I'm interested to see, because there's some predictions that there'll be like a prophylactic spinoff, like YouTube, for instance, will just be spun off, which I wouldn't mind. I'll buy some straight up YouTube stock. But so it's just interesting that like all these things are coming at the same time. Yet, even though Google's at a pretty good price to buy right now, their earnings were great and most of them have bounced back. So I don't know. I mean, that's kind of just an overview of a lot of the chaos. I've been talking forever. You take it away.
Sure. Yeah. I mean, I think Meta as we record this, I think Meta released this morning and they beat all their earnings estimates. There was a couple of them, like the tech was dragged yesterday, but then like it's shooting up again today, man. It's a wild world that we live in. And like we said a couple of weeks ago in the recording, like it's insane to think you might be able to predict what's going to happen. The only thing that I'm confident in saying is that it'll be volatile for a while. These tariff things aren't going to go away overnight, one way or the other. They're going to have an impact on how we see things going, and the interest rates is the other wrench being thrown into the mix. They started declining and then they shot up, and they don't seem to be reacting based on anything. I'm not even sure.
They're actually, the 10-year's actually down today after going up. Yeah,
exactly. Trust me, it's there's no rhyme or reason. You read an article that said, people are pricing in cuts later the year, and then you read another article that said, why, if they're pricing in cuts, why is interest rates rising right now? Like that's the opposite of people pricing.
Right.
It's like it's so many different inputs that aren't predictably going to continue that are causing everybody to kind of jump all over the place. I think, the Magnificent Seven, the big stocks, the Meta, the Googles, all those, the ones that have been carrying
Apple,
the market
Tesla,
for the past
Amazon.
few years. They're actually relatively flat on the year. They started down and then they're like, if you take a conglomerate, like the market is actually relatively, if you took January 1st and you took April or May 1st, there's not a significant change. Certain companies are going to have had bigger falls and bigger gains, but broadly, it's kind of weird also, that we're somehow floating around in the same spot. Even we've had some huge swings, but we're kind of like found our way back each time. It seems like.
Yeah, and if you look at like the difference between what a stock price is now or an index is now from its height when it was just off the charts, then it's going to look significant. But if you go just back a little bit further in time, it's not. Yeah, it's not near as it's volatile, but it hasn't lost near as much as you may.
Yeah, as it may seem like
it does based on the stories.
Like yeah. Certain days it looked like it was doom and gloom, but then a few days later it would be something else would be announced and off they go. I guess my point, and I wrote about it in this morning's newsletter, is that I just think if people, and this is my non-financial advisor, absolutely do not know your personal situation, but I don't know that I've ever seen a better opportunity for people to exit the stock market without significant losses and pivot. Well, if you read the newsletter, you'll know what I'm talking about. Pivot to a new strategy while the volatility continues, because we could come out of the volatility and start climbing again. We could come out of the volatility and drop 20%. Nobody knows what's going to happen. But if you want to reduce your exposure to whatever that is, this is a good time to do it. And I'm biased. I'm a multifamily guy. I get it. Real estate's my game. But if flat for all the potential warning signs that are flashing on tariffs, interest rates, inflation, jobs, all these things all these crazy inputs are coming out for not having crashed yet. I think if you're worried, if you're thinking about a pivot, I wouldn't wait anymore. Is I guess what I would say. If we're generally where we started for when the worst of the volatility, and we're still somehow in the same spot, you might miss out on a little bit of a run. But if it starts, let's say it's 6 months of volatility is coming. If you pivot for the 6 months, you trim your holdings in the stock market, and you put some of those investments in other things that aren't really tied to some of the crazy volatility that we're seeing. And then at the end of that 6 months, it's like a steady climb. All of the warning signs have diminished. We've fixed tariffs. We've fixed interest rates. The inflation is gone. Jobs are being added. Okay, you can come back in. It's climbing again, and fundamentals are strong. But the alternative is that if you stay in through the volatility, thinking, "Hey, it could come out positive. I don't want to miss out on that run," but it doesn't come out positive. Now what are you looking at? You almost can't get out if it crashes 20%, or you're along for the ride now, because otherwise you lose 20% of whatever you had in. So that's my philosophy on it. I think people never want to miss out on the party, and I think that keeps people from making pretty good strategic decisions. All things, all in this particular scenario, in my opinion.
Yeah, I think that's interesting. Though, I mean, it is so enticing to try to stay in. This is a little beside the point, but I think the ticker is like there's something deeply primal about it for like humans, like watching it go one way or the other.
Yeah.
And like the idea of it being green going up, right? Like that. I really
Sure.
do think, because there's a really good chance that if you have good stocks, like for instance, I was just looking, if you're watching, you've seen me looking off to the side. I promise you, I'm not watching TV. I was looking at the stock ticker and looking at a bunch of stocks that I follow. But it's interesting that Amazon has gone up over 5%, which is over $10 a share today. And Meta's looking like even better, I guess, off that earnings report. Amazon announced some investment. But then a lot of the other Magnificent Seven, or ones right outside of it that are also very strong, like Netflix, have barely moved. So, I mean, like you said, we don't know anybody's situation. So it could be a matter of you waiting until what stock you have a big control of does the wacky thing in your favor. But it seems like overall, if you've got a diversified portfolio, that, you're in a situation where you can, I think what I'm hearing from you, Matthias, is that you can understand it's a volatile time and maybe not the best time to be heavily invested in the stock market. You see those signs without having lost a lot, because it's easy to get out after you've lost a lot. Like, this is a terrible time, 100%. I'm out.
Yeah, right, exactly. Because it happens so fast. But like this entire month has been such crazy volatility, but we really haven't actually lost all that much on the broad spectrum, the market wide spectrum, that you have a chance to. I mean, I don't see the volatility going away unless people know things I don't know. I just think like, hey, let's say and I'm just going to make up numbers. Let's say you're 100% invested, all your investments are in the stock market, and you're in this situation. In my opinion, now's a pretty good time to cut 35% of that investment, cut 40% of that investment, and preserve it, leaving 65% in, 60% in, whatever you feel like is your number. And you can put that 35-40% into something else that isn't going to potentially crater in the next year or two, or 6 months or whatever, and wait. You know what I mean? Limit your exposure to that downside risk. I like to limit my downside risk. I like to live in scenarios where I may not gain a ton of money, but I'm not going to lose a ton of money. I don't want to lose a ton of money. So, that's kind of the strategy that I'm talking about.
Yeah. And like you said, first, you're not taking it all out. Second of all, I mean, you're investing in something that, as we've mentioned before, it is connected. We're not saying it's completely separate from the broader economy, but it is
in terms of real
cushioned
estate,
by ripples. Yeah. It's real estate, right? Like, it takes a lot of different things lining up and kind of sustaining themselves, and other market factors like demographics, population, stuff like that, to really affect a housing market. And even then, if you're invested in the right property, it may still not even affect it, because I mean, it takes a global pandemic to affect like all real estate.
Yeah. And I think that right there is a really good transition, because like we're talking about market volatility, a chance to escape it with like your, escape intact. But then part of the reason like I mentioned, limiting the downside risk, limiting the risk of losing your money or losing a portion of your money. I think that there are tailwinds in the multifamily sector that will help you avoid, even with continued volatility on the tariffs, insurance, interest rates, all these things. There's tailwinds, and we've talked about them before, because all that supply that has been delivered to these major metros over the past year, most we've ever had delivered in a year before, it's softening rents, it's softening prices, meaning you can acquire multifamily now at 3 years ago, you can acquire it for a much better price, say, according to the financials, than you would have paid 2 years ago or 3 years ago. And that's a buyer's market, right? Like that's hey, if there's lots of supply hitting the market, rents are not climbing because there's more units to fill. Now your appreciation isn't going on as fast, and I don't have to pay as much to get into the same property, all else being equal. That's a time to buy. The reason that helps limit your downside risk is that if is the buying right? If you have to pay more to get more in an up market, you have more risk of the market turning down. If the market's already turning down or already softening, there's less of the floor is higher, I guess is the way to put it. And so if you stick to your buying criteria to where, hey, if it cash flows and you're buying in a softening market, you're protected from a lot. Especially if you stick to like long-term fixed rate debt. If it cash flows today, long-term fixed rate debt, you're protected from a lot of potential shenanigans in the market. It's when you bet on appreciation you're buying and betting on appreciation to make returns. That's the problem. There may be, and most likely will be over the next few years, but if you buy a cash flowing asset in the next year and a half, I'm pretty confident you're protected from a lot of the downside risk, a lot of the potentially losing money, and more than likely you'll make a lot of money. But I cannot say the same for the stock market at this time. You know what I mean? There is a potential to lose a significant portion of money in the stock market. It may not happen. I hope it doesn't happen. I don't want people to lose money, but I'm personally much more comfortable protected from that volatility and losing 20-30% on horrible stock market crash. I'm protected from that by investing in hard assets that'll hold their value in cash flow and pay for themselves.
Yeah, I mean, to kind of build on the point of the softening, even if you talked about market softening, rents, and appreciation's not there, I had two thoughts about that. One is, as you said, if it's long-term fixed debt and you're getting it at a higher interest rate because interest rates are higher, but it's still making money. Right. Like, again, the floor is higher. Even if the ceiling may be lower, the floor is higher. Right?
Exactly.
Which is, for those of you that are sports fans out there, that's a common trope, right? The ceiling might be high on these people, but the floor is pretty low, or the vice versa. Do you want that steady team or that Kentucky team where they can beat anyone?
Who knows? Yeah.
Yeah. Beat anyone or lose anyone any day of the week. Yeah. So there's that. And there's also parking the money. That is one thing that kind of was why I brought up the whole ticker thing, right? Because it's not as exciting, right? Like you probably, if you actually compared how much you made over 5 years in the stock market versus 5 years in this real estate investment, I'd be willing to say you're going to come out as good, if not better, but it's hard to decouple yourselves from like that kind of the immediacy of it, right?
Watching it happen. Yeah. I agree, but it's also protecting you from yourself. In a way, I saw somebody post about this the other day. It's like, hey man, emotional decisions are hard to avoid, especially when you see the red and the down arrows and everything. It's a very tempting to say, I don't want to be exposed to any more of this, and I'm out. Tying your money up and protecting it from your own emotional decisions sometimes is not a bad play if you're prone to that, and you say, hey, it's just like telling your stockbroker if you're one of those types that have a stockbroker. I don't know, I don't have one, but maybe back in the olden days when you had to have one. You just be like, hey, don't take any calls from me for the next 30 days. I'm gonna call you chain me to the tree, man. Like, don't listen to me. Doesn't matter what I say. Don't do it. That kind of thing is like, if you lock up the money in a solid investment, you may not hit the ceiling. We're going to use that again. Yeah. You may not hit as high a returns as you might have if you for the super crazy stock market rally that comes out of a recession or something. But what you do is you've set the floor, like it's a cash flowing asset. You're not going to lose money on it. Like, my spirit animal, Warren Buffett, is always like, hey, just whatever you do, don't lose money. Try not to lose money in an investment. Aim for solid investments that are long term. Try not to lose money. And it's worked out okay. So,
yeah. And I mean, and then, oh yeah, absolutely. And in our particular instance, I mean, if you're thinking about you're buying existing, in a softening market, it's penciling, which means that there is actually some significant upside on a refi or something like that. But it's not, if, say, for instance, right now you have this respite where there's the pause and it's still uncertain. We don't know what's going to happen. But right now, it seems like you have a moment to get out if you wanted to, well, not completely, but you know what I'm saying, pivot, as you've said. But even if it does go crazy, that doesn't mean like the price of the lumber that was used to build the property that we already own and exist is going to go up right now.
Yeah.
It could hurt. It could hurt in the long run if you wanted to sell it. But if it's a cash flowing asset, you don't have to. You're already making money. And that's dividends right there. I mean, I think the argument for pivoting to at least some real estate investment is pretty strong. I mean, I think we make a lot of great arguments for this personally.
Yeah.
I
agree. And, I think we've beat the dead horse between my newsletter and the podcast today. But I did want to talk about one other thing that we're seeing in the multifamily market in terms of softening is I follow a lot of accounts, guys that are big economist guys, housing economists, and, they're all plugged into the big data, and they're really good at summarizing and parsing the data for people, so that helping us understand what it means when they're looking at 148,000 units delivered here and there and all these different things. Basically, a lot of things that they're cautioning is that, hey, the bottom is not here yet for some of these distressed properties. And so, we heard last year was big talking about, hey, a lot of these commercial loans, offices, multifamily, retail, a lot of these big giant commercial loans on really big properties, billions and billions of dollars, are in distress, and they're coming due in the next 16 months. Back in the beginning of 2024, they were talking about that. And what the guys are now saying is that, hey, there's still quite a bit of those distressed properties. One, there's still a ton of them that haven't been resolved yet, meaning they're negotiating with their lenders. The loans are due, but they're not necessarily like, hey, taking the property back yet. They're working out extensions and things. A lot of that's going on right now, but there's a lot that, the number of distressed properties is still climbing. So like the tail end of people who bought at right before, beginning of 2022, assuming they were going to be able to refinance in 3 years for, with a 4% loan, those properties under distress now that interest rates are 6.5%, 7% are looking at not being able to cash flow. So the numbers are still ticking up of distressed properties, I guess, is what they're cautioning, which makes sense because it just takes a long time for distress to shake out in a bigger and bigger deal. Unfortunately, it could take a year for just an average homeowner. If you get underwater on your house, it could take a year for all that to go through the process and kind of where the bank takes it back. That's not uncommon at all. But with big giant commercial properties, it can often take even longer because banks aren't operators, right? They're lenders, but they don't want to operate. So they want to find either a new group to come operate and relieve the distress. Maybe the distressed property will recapitalize, which we're going to talk about in a minute. But basically, all this adds to kind of fire to the smoke to the fire, whatever, that it's a buyer's market. So there's a lot of distress coming out. Fuel to the flame, something like that. I don't know why. I was thinking if there's smoke, there's flame, but that's not, as I was mixing my...
If there's smoke, there's fire, but that's not the right one, no.
That was a...
Wow, you just poured gasoline on your own attempt at metaphors is what happened there. You just lit that on fire.
I sure did.
Fuel to the flame.
Fuel to the flame. There we go.
Your argument. Yeah. I know
that it's a buyer's market, that there is opportunity coming onto the market, to whether it's to even, and I like to say it all like trickles down the level. So if $100 million property is under distress and all the big guys are going after it to buy it at a discount, because it's in distress, they're not splitting off to look down at the $50 million deals and on down the chain. So it opens, even though some of the big giant players that are in real distress, I don't have a chance to go get $100 million, not at the point we're at, but it's a trickle down effect all the way down through the market, so that the $10 million properties are that are in distress. There's not big guys trying to swoop in and get those just because they're in a discount. They're concentrating on trying to get the next level up and so on. So it impacts the entire market all the way down through the tiers.
Yeah. So I think maybe just so everyone's clear, maybe I think I'm going to just try to, you're talking about financially distressed buildings. I'm not sure everyone understands what that means. Maybe okay. How about I take a run at explaining that just as a matter of like my learning here. And then that way we'll get an explanation out there so everyone understands.
Sure.
Okay. So the one thing that I guess I am a little bit unclear about is there can be financially distressed because they took on variable rate debt, but there also can be financially distressed because they bought something at a valuation and they're now underwater because that valuation has gone down rather than stayed steady or gone up. And that can be because either rents and income have gone down or just simply the market has changed. But I'm assuming that you're kind of talking about a combination of those where either they bought on a variable debt thinking that it had been so good for so long and they never saw it coming where it would be spike so fast, so fast. And therefore now their debt service eats away all of their income, which then reduces the valuation of the property. And then they're underwater and they're not making any money. The investors aren't making any money. And actually, as of right now, they have more in the deal than the property is worth.
Yes and no. So generally,
just like I like
correct. It. So the debt service doesn't affect the valuation of the property. What affects the valuation of the property is the income. So
well, yeah. So because they're having to pay more for debt service, the income is coming down.
When you're evaluating commercial properties, debt service is not part of the equation. So because it's the only way to compare apples to apples in terms of, because some people can qualify for better loans, and you're not
right.
You're bringing your own loan, or you're assuming a loan when you buy a property. It's not, it's kept separate from the valuation. But so here's how, kind of the other way. Those ways are correct. When you're in a variable rate and it cash flows under 5% interest rate, and even if you're doing well and your income is increasing, if your interest rate goes up to 7%, at some point it breaks through where you're able to cash flow, and now you don't have enough income to cover the debt service. That is where the bank goes, hey dude, you still owe me a payment every month, whether I don't care where it comes from, but I need to get these payments. And so if you go long enough where you're so you're not necessarily underwater in the valuation, but you still have to service that debt that you have on the property. So that's one way. Like you said, the other way is, even if the value is increasing of the property, let's say you had a fixed rate, 5-year fixed rate debt, you at 4%, you operated, you pulled all the cash, you're living the high life, and you expected to refi at 4% in 5 years. Maybe it went up to 4.5%. But if it's 7% at 5 years, you may not be making the income able to service that debt going forward. So you're coming up on the end of the term of your loan, so you're effectively, you have to sell for not what you wanted to get, because a buyer can't afford to pay 4%. If they could bring a 4% loan, they'd be able to pay you what the top dollar for it, but they're only going to be able to buy with a 7%. So nobody's going to buy a property that doesn't cash flow for the loan they're able to get on it. So that's where you start that's where the valuation starts coming down, is because nobody can pay what you want for it or what you thought you were going to get. So now you may be you're either not presenting a great return to your investors. And there's plenty of cases to where they bought on, super paid, absolutely tippy top of the market for it. The bottom fell out, and now you're looking at, hey, we bought for 25 million and nobody's going to buy it for more than 17 million today. And that's those things are happening in the market. It's not super common because it's typically long-term debt, and there's a lot of deals to be worked out. Again, like we'll get into in a second, that people are trying to do to save those deals and outlast the debt crunch, as it were. That's generally what I mean with stressed or distressed properties, is when the debt service is not there to cover what you would have to pay. You're not making the income to cover the debt service that you would have to pay in order to refinance or buy the property.
Right, because the income hasn't increased the value enough for you to have the equity built in to be able to get the bigger loan on a refi. And no one else is going to come in with that loan because they're not going to pay that at 7.5. Yeah.
Right.
Right. Okay.
So there's,
all right. And let's say, honestly, you see this. Oh, go ahead. Sorry.
Yeah, I was gonna say. So it was a good point you brought up, because basically, like, a lender is only going to give you what you can cover. They're only going to loan you what you can cover. So if you're, let's say, that $25 million property, if the bank goes, hey, your income is only going to be able to cover with our safety margin built in is only going to be able to cover a $16 million note, then you go, okay, well now there's 9 million of equity there I may or may not have in the property on the valuation. If the appraisal comes in less, then you got to pay to be able to refinance. You got to call your investors up, say, hey bro, either the bank takes the property back or we come up with a few more million to meet this gap, because they're not going to loan us enough. We got to come up with some more equity in the property. So that's another way that they can get distressed.
Right. And this is where I think this is one of those situations where the phrase good money after bad might come in.
Which is a perfect transition to what I wanted to kind of told you they were going to be fired today, dude.
Yeah, where's my DJ?
My metaphors are not good, but my transitions are going to be awesome. So basically, one of the ways that operators are trying to salvage and work their way through those distressed properties and those distressed deals is with what's called preferred equity. And it's basically where they raise more money that's going to sit in a higher position in the capital stack than the existing investors. And that at its core is why I detest it, is because let's say you raise $10 million to buy, or let's go with $5 million to buy the $25 million property. All right. So now you need $2 to $3 more million to refinance and stay above water in this property. The bank is not going to extend your loan at the same terms. You've run out of time. You have to do something. So you go out to new investors and you say, hey, we're going to raise pref equity on this existing deal to recap. They call it recapitalizing. And basically they go, okay, we're going to raise $3 million to get this thing to where it'll cash flow properly. But to incentivize the pref equity investors, the preferred equity, the new investors, we're going to say, hey, we're going to give you a higher position and oftentimes a higher percentage of preferred return on your investment than we ever gave the initial investors. So what that does is now there's $3 million. Here's how the capital stack will go in that scenario. The loan, the bank that lended on the property gets their money first, always, right? You have to pay your debt service.
Yeah, of course, yeah.
The cash flow existing after that goes up to that, whatever that percentage is of the preferred equity investors. And then whatever's left goes to the initial common stock, common equity holders, if anything is left. And the same thing goes for whenever the eventual exit is. So now you've got, obviously the let's say you sell the property for 25 million. You've got, okay, the loan was whatever I said it was. That's getting paid off obviously first before you do anything else. Yeah, no, the loan, the loan on the property, the original loan, it's 17 million, whatever it happens to be.
Right. Okay. Yeah.
Yeah. So that gets paid off. Now you have $8 million left. You've got your pref equity investors, the $3 million of them, plus whatever you promised them. They're first in the stack, or they're next in the stack after the senior loan. They get paid off, and oftentimes what ends up happening is it wipes out there's no return. There's oftentimes complete loss of equity. Like, so your shares go to worthless in a pref equity because there's no more money to be handed out. The deal's kaput. There's no more money to go. We made the pref equity because that's the way it works. When you offer the preferred equity, they get theirs and they get plus whatever percentage you promised them of the rearages. If you didn't make the preferred return, which is often higher, 9%, 10% that you promised them whenever they invested, that all comes out of whatever the common equity guys were going to get. So when the money's gone, it's gone, and everybody goes away, and you just have to lick your wounds and move on. So that is the kind of how pref equity works. And there's ways to juice returns by using it, because it's almost like a second loan. So if you can take on more leverage, it's by nature, more leverage means more risk. But the person who's eating all that risk is the original investor, which is why I'm just unwilling to ever participate in anything like that. That's, in a way, it could be used to, if you just need to get past a hurdle and do some things, you need money to replace something, a deferred maintenance that's going wrong, and you just out of cash. Like, there's ways it could work where it saves the investment, but all too often, like I said, the more leverage you get, the riskier it is. All too often, it ends up, sure, the preferred investors might be okay, and the bank will always be okay. But whoever's hanging out down at the bottom looking for scraps may not get any scraps.
So is there anything that the common investor, quote unquote, investor, the first investor in pool can do to protect themselves in this situation? I mean, this is just, I assume this is just perfectly legal to just cut people out, even though they
it is
have invested money.
The way honestly, so what happens in these scenarios usually, and what should happen, is that whoever's operating the deal goes, original investors, we got a problem. Shouldn't be a big surprise because you should be regularly reporting to your investors of what's going on. But here's our problem: we need $3 million. What we can do is raise $3 million from you guys to save the 4 or 5 million that you've already put in here, or our other option is to go do pref equity. So if those original investors have another 3 million, they may do it in the efforts to not introduce somebody who's going to be in the capital stack ahead of them, to where at least they can kind of save all their money. But if they don't have money, or they just don't want to put bad money after good, or bad money after bad, in this case, good money after bad. I told you I was bad at metaphors today. This is terrible.
Woo. Idioms, metaphors, similes, colloquialisms, just
I told you I was stressed.
I've been
up since 4. Yeah, so basically they can try to rescue their own position, but that's a tall ask to bring. And I'm just making up these numbers. I don't, each situation is going to be independent, but that's a lot of that's a way they could save themselves. But you don't really have recourse. It's usually written into everybody's documents that the operators are allowed to conduct a capital call. Maybe their documents will require them to ask a capital call and see if the original investors can bring more. But
any operator, all comes down to what you agreed to with your the contract and the sub. Okay. Subscription.
The best way you can protect yourself from this is to choose your operator very carefully, because if the operator is going to sell you out at some point, and it may not even be them selling you out per se. It depends. They're going to try to escape from a bad situation however they can, and you got to choose that operator carefully. And realistically, you just need to choose the business plan even better, because you want to limit that. Like I said, like I always try to do, is limit the downside risk. Like, what am I entering into something that has potential very bad downside risk? Am I buying at peak market? Have they demonstrated its value add where we can force some of that margin to exist? Is it cash flowing super long-term growth with no supply on the horizon? Okay. You're protecting yourself. Are they getting variable rate debt? Are they getting long-term debt? How long is the term? What are the extension options on the back of it? That kind of stuff. That's how you can protect yourself from this scenario happening. And I'm seeing a lot of deals coming out where they, deals hit my inbox all the time. Hey, we're raising for this, that, and the other. And like over the past year, I've seen I never used to see them, but I've seen a ton of, hey, we're raising preferred equity, and it's on stuff we already own. We're just, we're boosting our returns, and it's like, I don't think that's what you're doing. I think you're trying to rescue some of your deals that aren't performing like you promised everybody, and I'm not going to go in as a preferred investor. I don't want to be a part of that, and take the shares of other people. And I realize that yes, could be scenarios where I'm actually rescuing them if I'm come in as a pref investor, but that's just not. In my opinion, there's plenty of pie to go around on the normal side without trying to get into, nobody has to lose in the way I like to do business.
Right. Yeah. I mean, you can just imagine the movie character villain, whose like whole gamut is preferred equity.
Yes, that's all he does, is that he just
looks for that distress. Yeah.
He wants to see people crying and going to the poorhouse.
Yeah. I mean, it's just like, exactly. It's Mr. Potter. It's a Wonderful Life. The whole time you've been talking about this, I've been listening and understanding. And although I got to say, I didn't understand that last part about preferred equity, that the other people would just get nothing. But I just keep thinking about that zombie building in Chicago. I'm sure you've read about this. There's like one huge, massive tower in Chicago that's like almost entirely empty.
I think I've heard about it. I think there's something kind of like,
it's like the biggest example of, never recovered from the pandemic, and, kind of all the whole things that you're talking about, just happens to be a skyscraper rather than, a normal size building. Well, so I think the takeaway here is, for those of you out there looking at investment opportunities, there should be some language one way or the other in the contract or subscription agreement or whatever you are shown that that speaks to preferred equity? Where would someone look for that if they
not necessarily?
Wanted to make sure?
I mean, if it's a deal that's offering preferred equity, then it'll say this is a preferred equity.
Oh no, I mean like the original.
Yeah, I mean, it's probably not going to be mentioned unless it's deep in the operating agreement somewhere where it says, hey, the sponsor reserves the right if, first must conduct a capital call to try to alleviate the problem, first right of refusal to the existing investors, and then has the ability to take out loans or offer preferred equity later on. So that's almost exclusively, that's going to be in almost every deal. I would just say you're much better protected if you go, hey, what's the downside risk to the operator? And they should be able to explain, hey, we're hedging against that by buying at this big discount, by long-term fixed rate debt, by having multiple ways that if they don't seem to understand what you're talking about, that's a red flag. But it is one of the real risks when you do this type of investing, but there are plenty of ways, and it involves discipline to avoid not being greedy, basically to avoid that huge downside risk that you can get yourself in trouble.
Okay. Well, we covered a lot there. Hopefully we tied the pieces together and you guys enjoyed kind of seeing how all these fit together in a way. I know I really like to make sure that, rather than I love the deep dives we do, but it was nice to kind of try to tie something specific into the bigger, probably, as I feel like say every single time we end a podcast. Oh, wow. It's almost 50 some minutes in. We probably should wrap this up.
Yep.
But we hope that you guys enjoyed listening, learned a few things. We appreciate you hanging out and listening to us. As always, if you liked what you heard, I appreciate what we do. Let us know, send us a note, DM. You can heart, restack, 5-star on any of the platforms. But honestly, I mean, as much as we'd like that, we'd love even more to get a comment, even if it's critical, honestly. Just, knowing that we're not speaking to the void. I mean,
something maybe.
You'll have to search, but I'm sure there's something. Anyways, as always, we appreciate you hanging out with us, and we look forward to speaking to you next week on another edition of the Get Invested podcast.
See ya.
Less than a mile from the center of town, a famous old stadium's crumbling down. No one's invested so much as a penny. Bring on the dead boo and Rob McElhenney. King Street was calm for the Saturday night, apart from the usual worrying sight. Zombified corpses parade in the streets, arched over flower beds slumped across seats. Massed near the bus stop for Moss and Brintake, a zombie apocalypse, modern day plague, a stone's throw away or a 2-second ride, where the Spoons locals were smoking outside. Old stadiums crumbling down. No one's invested so much as a penny. Bring on the dead boo and Rob McElhenney. Less than a mile from the center of town, a famous old stadium's crumbling down. No one's invested so much as a penny. Bring on the dead boo and Rob McElhenney. Ryan Reynolds and Rob McElhenney, a knock-killer pat down and thrown in the Gwenny. Ryan Reynolds and Rob McElhenney, a knock-killer pat down and thrown in the Gwenny. Less than a mile from the centre of town, a famous old stadium's crumbling